All right, what's up, future CPAs? So you're in your second or third year, and you know the LCPA is like the ultimate final boss waiting for you down the road. To even stand a chance, you got to start building your skills now. So today, we're going to zero in on two topics that I guarantee you will be on that exam: the cost of debt and the cost of preferred stock. Let's do this.
So let's be real for a sec. You can totally cram a bunch of formulas for a quiz next week, right? We've all done it. But will you remember any of that stuff when you're sitting for the actual boards in like 3 years with all that pressure? That's the real question. What we're doing here isn't about cramming. It's about making the stuff stick, like for the long haul. Okay, so for the next few minutes, we are going to completely crack the code on these two huge LECPA topics. I'm talking about the cost of debt and the cost of preferred stock. We're going to break them down. I'll show you exactly where the tropes are, and then we'll wrap up with a quick-fire review you can literally use from now until board exam day. Sound good?
All right, let's kick things off with the cost of debt. And I know, it sounds super straightforward, but you'd be shocked at how many people get this wrong because of one huge, massive misconception. And we're going to blow that up right now. Okay, so if you remember only one word from this whole section, make it this one: current. The cost of debt is all about what's happening today. It's not about some old loan the company took out 5 years ago. Forget that. It's about this. If that company walked into a bank right now to borrow money, what rate would they get? That rate is based on today's market, today's economy, and how risky the company looks today. The exam wants you to think like a real-world analyst, not a historian. And boom, here it is, the number one trap they'll set for you. The problem will dangle the nominal interest rate right in front of your face. You know, the coupon rate that's printed on some old bond. That's the bait. The rookie move is to grab it. But the pro move, the LCPA passer move, is to ignore it and look for the yield to maturity, the YTM. The YTM is the real current market rate. It's what investors are actually demanding today. Always, always, always choose the YTM. Okay, but wait, there's more. Debt has this secret superpower, a cheat code, really. It's something that makes it way cheaper than you think, and it's called the tax shield. This is super important. So how does this work? It's actually pretty simple. You know how companies have to pay taxes on their income, right? Well, when they pay interest on their debt, the government lets them subtract that interest payment from their income before they calculate the tax. So less income to be taxed means, well, a smaller tax bill. It's literally cash back in the company's pocket just for having debt. Yeah, you can really think of it like the government is giving companies a special discount coupon just for using debt. It's like they're saying, hey, borrow money and we'll help you pay for it a little bit. And that's a huge deal because it means the YTM we talked about, that's not the final answer. We have to apply this discount to find the true cost of debt. And pulling this all together is just a super easy two-step dance. Step 1, find your starting point, that pre-tax cost. And what is that? That's right, it's the YTM. Step 2, apply the tax shield. You just take that YTM and multiply it by 1 minus the tax rate. That's it. That's the whole move. And that brings us to the magic formula right here. The after-tax cost of debt is just your YTM times 1 minus the tax rate. Seriously, this formula needs to be burned into your brain. Take a picture of this, write it on a sticky note, put it on your mirror, whatever you gotta do, you're gonna need this for sure. Okay, deep breath. We've conquered debt. Now let's pivot and talk about its kind of weird cousin, preferred stock. People call it a hybrid security, and that's because it's like a mashup of debt and equity. It's got its own little quirks, so let's check it out. So, the cost of preferred stock is pretty much just the return that investors expect to get for owning it. And here's why it's a hybrid. On one hand, it's kind of like debt because it pays a fixed dividend, right? Like a steady interest payment. But on the other hand, it's like regular stock because you own a piece of the company. Oh, and here's a key difference from debt. Those dividends, nope, not tax deductible.
Now, when you first see the formula, you're going to think, no way, it can't be this easy. It looks like a simple dividend yield, right? Just the annual dividend divided by the price per share. But don't fall for it. This is another one of those classic LECPA traps disguised as an easy question. And this little gem from review materials is the key that unlocks the whole thing. It says the price should be net of any flotation or issue costs. So that price per share in the bottom of our formula, it's not what you think. It's the price after you've paid all the fees to get the stock out there.
So, What in the world are flotation costs? Just think of them as all the fees the company has to pay to launch new stock. We're talking about paying the investment bankers, the lawyers, all those people. The bottom line is, these costs eat into the money the company actually raises. It reduces the cash they walk away with.
So here's the alert, the big takeaway. You always have to use the net proceeds in your calculation. That means you take the market price and you subtract those flotation costs. The real formula is the annual dividend divided by that lower adjusted price. Forgetting to subtract those costs is like the #1 unforced error students make on this question. Don't let that happen to you.
Whoa, okay, we just went through a ton of stuff. We broke down the ideas, we spotted the traps. Now it's time to lock it all in so it actually stays in your brain. Let's do a super fast bullet review. Think of this as the ultimate retention hack for the boards.
Let's run through this table side by side. For cost of debt, the main idea is it's the current cost to borrow money. Simple. For preferred stock, it's all about the dividend yield investors are demanding. Got it. Now look at the bottom row. This is the money shot, the LOCPA watch out. For debt, what's the trick? You gotta make it after tax. Why? Because interest is tax deductible. And for preferred stock, it's net of flotation costs. You always subtract those issue costs from the price. Honestly, this one slide is basically your cheat sheet for this entire topic.
So now you know how to calculate the cost of these two big pieces of the puzzle. But here's where it gets really interesting. How does a company decide the right mix? How much debt versus how much stock? That's the whole art and science of capital structure. And what we covered today, that's the absolute foundation. It's step one. So keep digging deeper, keep asking why, and trust me, you'll be ready for whatever the LECPA throws your way. Catch you on the next one.